Meanwhile, the dollar's weakness helping stocks overseas. ETFs tracking France, Germany, Japan, all hitting records today, while the Brazil ETF was at nearly four-year highs. For more on investing abroad, Oakmark's David Herro joins us now. He's the co-CIO of International Equities and manages the Oakmark International ETF. David, great to have you with us.
Thank you for the invite today. Happy to be here.
This is certainly the dollar weakness, certainly a tailwind to international investing. But what are some of the other sort of fundamentals going on in other places that make those equities attractive?
Well, you're exactly right. I mean, since it bottomed basically around 2011, 2012, at around the DXY was at about 75, and then it hit a high of about 105, 110, and 10 years later. Now we're just at 95, 96. So it's just given back maybe the top 10% of that rise. The strong dollar has been one of the reasons why the international equities as an asset class has underperformed the S&P over 7.5, 10, and 15 years. That's not the only reason. The other reason is there's been massive multiple expansion of U.S. stocks and devaluation of foreign stocks. So you've had a double impact causing this underperformance over 10 and 15 years. Now we're starting to see a turn. You mentioned the dollar, but the earnings growth of these foreign companies is coming through. Of course, not as robust as the U.S., but still. And meanwhile, traditionally, foreign stocks trade at about a 14, 15% discount to U.S. stocks when you look at 1 year out PEs. Today, we're still at a 25, almost 30% discount. So you still have undervalued stocks with undervalued currencies, which have just quietly now have risen a bit. But I believe there's a lot more room, that this is not normal, that this spread, what we pay for these financial assets, is still too large. So there's still room in the dollar, and there's still room in foreign market, foreign stock equity valuations to revalue.
Where are the biggest disconnects in terms of valuation, David, when you take a look at either sectors or geographies? I mean, as you had mentioned, as you alluded to, tech really drew a lot of investors to the United States because of the concentration there. But, in other places, financials or industrials are strong and well represented in overseas indices. Are those valuations still attractive relative to what we're seeing here?
Yes, you look at certain stocks, whether they be in the pharma sector, which is very strong sector located outside the U.S. because the Swiss and the U.K. have big, strong pharmaceutical companies, AstraZeneca, Roche, Novartis, et cetera. They're still selling at good values. Consumer discretionary is a space. People used to pay up for the stability of consumer discretionary and consumer staples in particular, maybe not as much discretionary. These are looking very, very attractively priced. Companies like Danone and Unilever. So there are areas, luxury good. U.S. really doesn't have a luxury goods sector. And for the last year or two, primarily because of the weakness of the Chinese consumer, probably a big function of the real estate bubble popping, primarily because of this weakness, companies like Louis Vuitton and Kering and Richemont, of course, is Cartier, they have not really sold at these kind of valuations when you look at normal earnings in a long time. So these are all things, in our view, that represent good value, and they're all global companies. People don't like to invest in European companies because they see slow growth, bureaucratic, overregulated Europe. All true. But the businesses do business all over the world. If you look at a company like BMW, 1/3 of their business is Asia, 1/3 is Europe, 1/3 is North America. So these are really good global businesses that have their valuations being punished because of where they're being located. We think it represents great opportunity, especially when you look at a company like BMW, the free cash flow yield well over 10% and probably growing 4 or 5%.
David, it's Karen. Thanks for being on. So we saw from the notes that you think Japan is expensive. Can you talk about how expensive you think it is and what you think about it more broadly?
Here is the issue with Japan. As value investors, and at Harris Oakmark, this is what we hang our hat on. We're value investors. Value to us is not just the price you pay, but it's a fraction. It's what you get for the price you pay. So if you look at the average return on equity of a Japanese company, quite skinny, 8 or 9%. Average return on equity of a U.S. company, well into the 20s. European company, in the high teens. So that's kind of a proxy for what you're getting. If you look at the margin structure, return on capital structure, all the same thing. Japan, very low. What about the price you pay? The price you pay for Japanese equities is about 18, 19 times. Not as anywhere near the peak what we saw in 1989 when it was at 65 or 70 times, 5 times book value. So the market has derated. But in our view as value investors, who also consider the quality of the business, what we get, it's just not there. It's really hard to find. I mean, take a company like Kao, kind of the Procter & Gamble of Japan, has 9-10% margins. Procter & Gamble has mid-20s. Reckitt Benckiser has mid-20s. So there's just this disconnect between how corporate Japan is run. And that's not saying we want to buy a Japanese stock. We do. We have owned them, and we're overweight in periods of time. But the risk return, what you get for the price you pay, just isn't there for a value investor, despite the run it's had, by the way.